Hi, everybody. Thank you for checking out this March 2023 update on the current housing market here in Massachusetts. I am joined by one of my preferred lenders and old friend, Andrew Smalley. Andrew, you want to say hello?
Yeah. What's up, everyone? Thanks for having me on, Steve. Appreciate it.
um, First, I just wanted to thank anybody and everybody who donated to my St. Jude fundraiser that I held last month, the 2,800 push-up challenge. Really thankful for meeting our goal and really thankful to anybody who donated their hard working money to such a good cause. I just wanted to get started real quick by sharing my screen here for a minute. Um, This is a report that was provided to me by the Massachusetts Association of Realtors. And it's just a quick overview to give us an idea of what's going on this year as far as the real estate market's concerned. Overall, as we can see, the real estate market has actually trended downward as far as the amount of transactions. I think we're going to hit on this quite a bit today, but having to do with the interest rate environment. People are a little bit more hesitant to make that move, but we're continuing to see prices remain elevated. Basically, we have the same median sales price that we did last year, this year at 520,000 for a single family dwelling. And then actually condominium sales jumped up precipitously here as far as the average sale price, almost 10% year over year. I wanted to go back and show you guys one more piece of data that I was able to run that I thought was interesting. Um, so this report will show every year what the market kind of looked like as of March 8th in that year. So as of March 8th in 2019, we had 8,722 listings. 2020, 7,000 listings. And then here come the beauty. COVID really changed the game quite a bit, and it's remained very historically low inventory all the way up until 2023, where we're still extremely low compared to what I would consider to be, a normal inventory environment. And then again, if we look at the closed units as of this time during the year, we're actually down, I would say, close to 20% or 30% on average year over year. So the one thing that we are noticing is that the challenging thing is the entry to the marketplace, the first time home buyer. And we know that it's stressful for a lot of the people trying to enter into the market, the millennial generation, the young people just kind of trying to get established. So I brought Andrew here today to kind of help us give us some tools basically that he has available that I think you'll find interesting. So Andrew, do you want to hit on that at all?
Yeah, for sure. Yeah, first, I mean, those numbers are pretty staggering. It's what so much has changed, and just like with housing, you're seeing there with COVID, rates were drastically affected by COVID as well. But what I'll dive into first is kind of the first time home buyers, right? Because they have been at such a disadvantage these last couple of years. What was a booming sellers market, people coming in with cash offers, waiving every contingency under the sun. Like it just made it very hard for first time home buyers to compete. So now that, Fannie Mae and Freddie Mac, government backed entities, they have collected all this data and have created some really good first time home buyer programs to try to give them a little bit more of an advantage. So this new one is basically called it's a conventional 30-year program. So, and it's called an AMI program, or average median income. And basically what this means is as long as you have a minimum FICO score of 620, you make less than the median income, and you're a first-time home buyer, you qualify for this program. Now, I'll kind of touch on a little of what average median income is, because it's different for different counties in Massachusetts. Because Massachusetts actually has a couple of what are deemed high-cost counties. And those would be Middlesex, Suffolk, Norfolk, Plymouth, and Essex County. So a lot of the bigger counties in Massachusetts. So the income limits are very generous there, right? Because again, home values have gone up so much in the last few years. Because typically when programs like this used to come out, it would be great. It'd be, you'd have the, first time home buyer program and, low FICO requirements, but then it would be like, oh, if you make like 60 grand a year, you can qualify. So now the income limits are much greater. So as long as you make less than $159,960 a year in one of those 5 counties I mentioned, you qualify for this program. And what this program is going to do is it's going to just give you lower interest rates. So I'll give you kind of a quick example on how they do that. They remove something that's called LLPAs, and that stands for loan level price adjustments. So let's say, for example, you were purchasing a condo versus single family. Before this program rolled out, you would actually pay more for a condo because in the lender's eyes, a condo is a riskier purchase, right? Because you're dealing with an entire association with multiple units versus a single family residence. Also, if you were someone who had like, let's say a 650 credit score, you're also put at a very big disadvantage because the rate would be a whole lot higher. And then more often than not, it would come with also mortgage points. So the rate would be like a full percent higher, and then you'd have to spend sometimes 5 or 10 grand to even get that rate. So it really put them at a disadvantage when you think about buying power in a very competitive environment. So with this new program, it removes those LLPAs. So basically, someone who's got a 650 will get the same rate as someone who's got a 750. Someone who's buying a condo is going to get the same rate as someone who's buying a single family. So it just, again, gives these first-time home buyers a chance. It gives them more buying power as a result, so they can be a little bit more competitive with their offers.
So I guess my question would be, if when you say home buyers, sometimes people do buy as a couple, a young couple, say. The income restrictions, do they change based if it's one income or two income?
That's a really good question. So first, as long as one of them is a first-time home buyer, they qualify. So it was a son and a parent, they can still qualify even if the parent owns a home. But they do go off of combined income. But the really cool thing about this program is I only have to use qualifying income. So let's say, for example, we have a husband and wife, they each make 100K a year, right? So their combined income is $200,000, which is greater than that 159,960 number. So they wouldn't qualify. But if they can qualify for the home using just one of their incomes, just one of their $100,000, I can qualify them, keep them both on the mortgage, but just use one of their incomes to qualify. So there is ways around that because they allow us, thankfully, to use just qualifying income in that instance.
Right. And I was wondering, do you have any visuals that we could look at pertaining to how interest rates work? I mean, because it seems like they're really high right now, but I think from a historical perspective, it's really kind of normal. Is that right?
Yeah, it's a good question. That's probably been the hottest topic these last couple of months. We're talking a lot about interest rates. So interest rates, if you look at a 30, 40-year history, being in the sixes is a pretty, healthy market in terms of what you look at for the average over those last 30, 40, 50 years. But mortgage rates almost directly move with inflation. So if you turn on the news at all lately, you'll see that the Fed's primary goal is they're just trying to get inflation to 2%, and they're doing anything they can to do that.
I never heard the word inflation run around as much as it has the last couple of years, so inflation, and we all feel it and we all see it. So it's, it's definitely here. So
yeah, I feel like Google's top terms, if they were to, do some analysis on it, would be, inflation, recession, rates. I got to imagine those are some very commonly searched Google words.
yeah.
But inflation, so it's getting better. We're at about 6.5 now, way down from the summer where we're almost in the double digits. But let me just show you kind of a quick slide here. Let me just quickly share my screen. Here.
Sure. And while he's doing that,
so
I do want to remind people that the price range that's been challenging is this entry level price range, and it part of the problem is they really can't create more of these $400,000 to $650,000 houses because of the price of building something like this is not monetarily feasible for a builder or somebody to make a profit on. Several years ago, they'd be able to do that, but the prices of these materials and stuff have really kind of elevated to the point where they have to build these larger colonials further up close to like $1 million, especially in the area where we live in like the Medway, greater Boston area. So I just kind of wanted to point that out. As far as entering into the marketplace, I think that prices are going to remain elevated for quite some time. But go ahead, Andrew.
Yeah, I think you make a great point too, where we live in Massachusetts, right? It's one of the most desirable places to live in America. And when you factor that in with a low inventory environment, I mean, it's going to create a situation where I can't really envision home prices coming down a whole lot, if any. But this is just a good quick graph that just goes over really how inflation and mortgage rates follow each other. So the red line here is inflation, and the blue line here is your fixed mortgage rate. So you can see here how they, a little bumpy here, but a lot of it, they kind of follow each other, right? So when this ticked up, mortgage rates ticked up, right? When it came down, mortgage rates came down. And then here again, you saw inflation go up, mortgage rates came up. And then there was this QE period, which stands for quantitative easing, but you could just look at it as the COVID period, right? This is where the Fed just came out and said, hey, we're not going to let a health crisis turn into a financial crisis. They pumped the economy with a bunch of money to avoid us going into a deep recession, because the unemployment rate was almost as high as 15%. It was a pretty rough situation. So they did everything they could to pull us out of that. And that's one of the ways they do it, is using quantitative easing by pumping some money in the economy. But then you see, as soon as it kind of, figured it out that, they had to kind of pump the brakes on it. They couldn't keep mortgage rates at 2-3%. It was just not sustainable. Home values were going up 20-30%. So at that rate, home prices would have become extremely expensive. So now that you see inflation going up, boom, inflation going up here, you're seeing mortgage rates go right up with it. So they really do follow each other very closely. And as the Fed, like I mentioned earlier, their goal is to get that inflation to 2%. And as they continue to do that and get closer to that goal, we should see mortgage rates follow suit.
Yeah, absolutely.
Not to get to 2%. Mortgage, the Fed's target rate for inflation is 2%. Mortgage rates won't get to 2%. But I do think a realistic environment is, somewhere in the low to mid fives. And I think that is a very healthy housing market, having rates in that environment. I mean, barring another pandemic or a war, God forbid anything like that happens again, that would probably be an only kind of situation where we would see maybe a quantitative easing again, where they're pumping the economy with money to bring rates down. But that was always designed to be temporary, not something that was sustainable for the long haul.
Yeah, and as far as the rates and the prices are correlated, it seems like we had this real issue when it came to supply and demand, and that continues to today, where demand used to be this high when interest rates were 2 and 3%. Yeah, the demand came down to here, but the supply never changed. So we still have this issue, and like I said, I really don't see that changing here anytime soon. So Andrew, anything else you wanted to hit on here before we wrap this thing up?
No, I think we covered it all. I mean, you hit the nail on the head there with inventory. I mean, when the market crashed in 08, we had 4 million homes in the market, and there's less than 1 million now. So to your point, supply and demand really dictates a lot of this. But the only other thing I would add is, if you ever, I just love help people. So whether you're buying in a month or 5 years or 10 years, sometimes conversations kind of things can. And like I said, I'm fortunate enough to have a career that I love, and I nerd out on this stuff big time. So if I ever can help with anything, please don't hesitate to give me a call or shoot me an email.
Yeah, and I can speak firsthand on Andrew's enthusiasm and experience. He's done a very good job for my clients, and I really enjoy working with him on my end as well. So, Andrew, how can people get a hold of you?
Yeah, I appreciate that. Yeah, I mean, you can any of the three: call, text, or email. But I always think a phone call, because you may think of some questions. Sometimes you can't really think of some questions through email and that kind of conversation, where when we're on the phone, a lot of times I'm talking with people for 30 minutes or an hour. So it really opens the door for questions to pop up. And, you know, information is power when you're, you know, potentially taking on the, you know, the largest debt of your life. You want to make sure you're as educated as possible. And a lot of that will kind of come out through conversation on the phone. So I'm always around. I work nights, I work weekends. So if you ever have any questions, my cell's 508-654-4840, and I'd be happy to help.
All right, Andrew, thank you so much for helping me with this video today. I hope that we're able to do this again in the near future. Maybe we can hook up in April for a new update.
Yeah, I would love that, man. Thanks for having me on.
All right, thank you guys. I appreciate it.